And it's like, oh, he's like,
That's it.
like, we'll have to go.
That was the best bit.
Yeah.
The last 10 minutes, that was the best bit.
Oh, sorry.
Yeah.
Okay, everybody, we're back again. Sorry, we're just getting reset. Steve, I need your phone. Okay, so we'll just jump back online. So I hope you all had a lovely lunch. Let me just find this presentation. Oh, I just had it here, sorry. There we go. And I've just discovered I can do that. There you go. I don't know if that made any difference to you. All right. It takes a couple of minutes for it to recognize.
No, that's fine. It's good. Okay, so we're right to go again. Second session, if you like. When we went through the 21 steps earlier, 2 of those steps involved ownership mindset and talked about employee ownership within the business. So one of the things that's become really popular over recent years is employee share ownership schemes. So I want to talk a little bit about that today and what are some of the advantages and what are some of the structures that we can use around implementing an employee ownership share scheme. So talking about really how to attract, retain, reward, and motivate key employees. So talking about ownership, employee ownership, different way of thinking about business, targets obviously long-term sustainability because it recognises employee owners are more committed to developing innovation, products, procedures and that within the business. The results competitive advantage, lasting success in good times and bad times. And in reality, all the studies show that that is the case. So where we have employee ownership share schemes in place and they're operating well, then staff retention, better productivity, more profitability are the results. The other thing about it is if we're talking about retaining staff, then we need to contemplate what happens if somebody leaves and we've got to recruit them. So it's been estimated that recruiting somebody, recruiting a replacement is going to cost you around about 45% of the annual salary. So if we've got somebody on 100 grand a year, for example, and when they leave and we've got to replace them, by the time we go through the process of getting somebody and training them up, etc., it's going to cost us about 45 grand. So clearly part of it is that we need to actually try and work at retaining our good employees. And that's particularly the case when we're talking about professional services. And we talked about that a little bit earlier when we're talking about, yes, we can have systems, checklists, procedures and all that sort of thing in place, but we're still, for a fair bit of what we do, we're relying on the expertise of our individual employees. So the things are, yeah, that's right, recruitment, training, lost productivity, downtime, estimated to be about 45%. The other thing is, I suppose, what are you telling your staff by the way you pay them? So remuneration is not about just the money, it's about also some sort of motivation and reward. So if we talk about remunerations comprised of both economic and non-economic benefits, then that can increase productivity and morale within the business. So as I mentioned before, all the research shows that if we've got employee ownership, then that's better for business. In reality, in Australia, we've lagged behind a fair bit in terms of the rest of the world in terms of employee ownership. For example, in the US, it's pretty significant there. And I think one of the things that's happened in Australia is that we haven't really had a great mechanism for smaller businesses to be able to do this economically. So most of the larger companies in Australia now, the listed companies, have employee share ownership plans. Smaller businesses, small to medium enterprises don't necessarily have it because they haven't quite had that mechanism. So we might be missing out maybe on those benefits of having employees thinking and acting like business owners. The other thing, though, is to be careful about the idea of jumping straight into offering equity. So we often talk about a bit of a ladder to equity approach, just a bit of a framework to manage that transition from somebody being an employee through to the process of them becoming an employee owner. So if we talk a little bit about the ladder to equity, Warren Buffett often talks about employees are keen to climb the ladder, but someone needs to provide the ladder. So that's what we need to do. We obviously need to provide the ladder for our employees. So we start off, the first stage is where our employees are earning income. So they're getting their wages, their hourly rate. That's where most people start and often stay, if you like, as far as their wages and salary goes. The second element is we sometimes provide some sort of an income model. So we might pay bonuses, commissions on sales or incentives, and that can increase an employee's income. I think this step's relatively common, particularly in sales areas and so on. If we're going to have an incentive scheme, a bonus scheme, we need to be careful how it works, because too often we see schemes introduced where there's unintended consequences. So we've probably all heard the stories about the salesmen who get paid a bonus on their monthly sales, and they get to the week 3 of a month and they're not going to meet their targets this month, so they hold off the sales till the next month to make sure they get it the next month, and so on. Scenarios where if they're getting a commission on sales, they don't worry too much about the gross profit and will often discount, etc., to get more sales. So there are potentially lots of unintended consequences around how we're going to structure those bonuses and commissions and incentives. And then at the other end of the scale, if we've got a discretionary type bonus where we simply get to the end of the year and we've gone pretty well and we're going to give everybody a bit of a bonus, then that can be an issue too, because people don't necessarily relate that to how they've performed in their job. So when we're talking about introducing some sort of income model, what we're going to try and do is structure a system where we can actually link the employee's remuneration to their performance in their job, and their performance in the job should be linked to the performance of the business. So the next step to that, I suppose, is some sort of a profit share. So if we give them a share of the profit, so they will now start to think a bit more like a business owner. So they don't actually have ownership in the business, they don't actually own shares in it, but if the business makes a profit, then we're going to give them a profit share. So again, we need to be careful how we structure this. So I'll give you a couple of examples. So if I go back again to our income model, I was at a business recently where they just paid out their end of year bonuses to all their, it's back, okay. They just paid out bonuses to all their senior management people at the end of the financial year. And I said, but you didn't make a profit. But everybody met their targets. I said, well, maybe your targets are not right. So everybody met their targets, had to pay their bonuses. So that's what I'm talking about, some of those unintended consequences. They're not necessarily measuring the right thing. If we get to profit, we need to make sure that we're going to allocate based on the right sorts of profits and how we're going to calculate that as well. So a couple of different examples. Some managers in one company I know, they get a share of the profit each quarter. And the business has struggled for a little while and had a period of time where it hasn't made any profit. In fact, it's made a loss. But as soon as it went back to profit in a quarter, they got their profit share again. They didn't have to make up for the time when it was in loss. So it's crazy, I know. So just being careful about how you do that profit share. The other thing when you're talking about profit share, the difficulty sometimes, particularly in smaller businesses, is that the profit that we measure or report, it's not always 100% reflective of how well the business has performed. Because, for example, there might be some owner's expenses in there, or there might be some one-off expenses, or there might be some other income in there that we wouldn't normally associate with the business. So what we would normally do if we're talking about this, we would be talking about a normalised profit, where we actually adjust the profit to what we think is a normal circumstance.
What about amounts of scheme debtors? Like it might be a profit which is debtors to the pie. You don't have cash flow, pay the profit.
Yeah, correct, yeah. So that might be one of the KPIs, depending where you're at. Yep. I've seen heaps of schemes around profit share over the years. There are very few that are really effective because they don't quite measure the right bits and pieces. Which leads us to number 4, which is where we're talking about this equity. So we're trying to provide employees with shares in the business. And so they transition to have this sort of ownership within the business. They've now got some shares in the business, they've got some equity. So if the value of the business goes up, then the value of their shares go up. If the business pays a dividend, then they're going to get a dividend as well. So they're actually now tied in to the profit. And that's your point exactly in terms of cash flow. We won't pay a dividend unless we've got the cash flow for it. So we're not going to give them the profit share. We're going to actually make the profit. We're going to generate the cash from it, and we'll pay it out as a dividend. Everybody shares. And then the last section is where we talk about control, the last ladder to equity. Doesn't always have to happen, but this is just angling a little bit what I was talking about earlier, where we need to actually transfer both the ownership and the management. So management, I'm talking now really at the top level, that control. So final step in that succession is, where the employee takes over the general management, or maybe becomes the CEO, or takes up a place on the board. So again, that's that last final step in terms of that ownership mindset, and also that employee ownership. I think the ladder to equity actually provides a structured framework to get to the point where those employees are in a position to be able to take over that control of the business. Okay, there it is, just in that summary, that ladder to equity, down from the employee earning income all the way up to that equity and control piece. Okay, so just a quick little exercise for you. Think of a key person in your organisation, take them through the ladder to equity in your mind. So what do you think would need to happen at each stage of that progression? So if you've got somebody on an income model, how would you progress them through those stages? I'll give you a few minutes and we'll get some feedback. Yeah.
The same class of shares.
I'll come to that. I'll come to that. I'll tell you the mechanism later.
So, the issues with response capital going to lots of small
Yes. Yep. Now I'll talk about the mechanism. That's all right. Okay, have you got any thoughts? How can you move somebody to move an employee to an income model under your business? Any thoughts? KPIs?
Probably defined by role or tenure, like the tenure, but maybe not from the start, but from 1 or 2 years of employment, and that's right. So,
yeah, okay, yep. So that's still that retention bit too, isn't it? If we're trying to aim for that, that's good. Yep. And KPIs, profit share. So profit share could be KPIs. They could flow into both of these. That's where we need to make sure we've got the right KPIs. Yeah.
Employee buy-in, like they have to have them.
Yeah, they might want to buy in. That's okay. So that'll get them into the equity.
But I mean, for them to be interested in having, like.
Well, I guess they won't get. I think it's a profit share. Like if they don't perform, then there will be no profit.
No, that's right.
No, but into equity, yeah. You want to make sure that they're engaged.
Use the profit share to purchase the equity because they haven't received the profit, which goes towards their equity purchase.
Yeah. I'll talk about some mechanisms for that later on. Yeah.
From that point, the profit share probably has to be individualised a little bit as well, because if 3/4 are hitting the KPIs too.
Yeah.
And then the business profit is higher, but then 25% of staff say.
So later on, I'll talk about how we would structure a performance employee share plan, but I would structure a profit share the same sort of rules. So I would set a profit target. Let's pick a target. Let's say it's 80% of what our budgeted profit is. And we say, whatever we make over that amount, we're going to put 20% into a bonus scheme. Or a profit share scheme. So that's the first thing. That's how much goes in there. And then the second thing is we need to decide who's going to get what out of that. And so that's where our criteria comes in. The things you're talking about, how long have they worked for us? What's their score on their annual review, for example? What's their salary? So we might make a combination of those to get a score and go, okay, well, they're not all going to get the same because they don't quite contribute equally.
Yeah, balanced scorecard of inputs.
Yeah. Mm-hmm. And so then we're getting away from that, we made profit is everybody gets their 10 grand or whatever it is, And it means that if we're actually doing that on the basis of their performance and how they score on their annual review, then they can see that the job they're doing on day-to-day actually links to the performance of the business and gives them something to actually aim for. Okay.
I guess that's why it's not all income based as well, because if it's operational based as well, then it's a link to it. You know, because if you're operating a good or target, or the target that you want the business to be doing, then you might be entitled to more of that profit rather than less, like if there is that
Yeah,
sort of
yeah.
data as well.
And you've got the issue, so I've got one client works in geotech, they've got people working projects over here and they all make the profit. They've got a lab over here that provides the support services that doesn't make any profit because it doesn't invoice anybody, but they're just as important. So how do we measure their contribution to that profit?
Steve, is it, you know, we talk about valuation of business.
Yeah.
And valuation of business is a result of obviously profitability, NPAT, EBIT, and so on.
Yeah.
Is it easier, I might be oversimplifying, but is it easier to base this equity on increasing value of the business?
Well, it can be, potentially. So you might measure it that way. Because I think the value, and that gets them thinking more along that equity line, because the value is not only the profit. Obviously, if we increase the profit, that will increase our value, assuming the risk side of it stays the same.
Yeah.
But if we fix some of those other risk things as well, then the value goes up. I think that's the advantage of getting them into a share scheme, because then they're sharing in both that profit and the increase of value. Okay. Ladder to equity. So let's talk a little bit about ownership mindset. I've mentioned this briefly this morning. Ownership mindset is actually a program that we run, but it's got some principles that you can apply anywhere in your business in reality. So there's a few key elements to this. It's a program that helps employees think and act like business owners, and that can obviously improve their performance and their engagement and the retention of employees. It's based on a 4-stage model. It covers the personnel, it covers the knowledge that they've got, it covers the systems that we use, and it covers then how we structure our incentives around that. The process we use, we do a survey of the employees, we do a workshop with them, we workshop around through the KPIs, we set up a steering committee, actually put it all in place and implement some key improvement areas within the business. But the same principles you can apply to just helping your employees. So in reality, a lot of business owners, they're looking for better ways to engage employees and have them more involved in the business. Ownership mindset is sort of aiming towards that, getting them more involved. How many here would share your numbers with employees?
Oh, headline.
Headline figures, yep, okay, yep. An interesting one, because once we start getting into talking about employee share ownership, etc., then they'll be sharing, they'll know how much you make.
What numbers, sorry?
Oh, just your profit and losses, balance sheets, financials, etc.
That's fine. She knows everything.
Because it's an interesting concept. Some people really struggle with that idea of letting their employees know. I have done it a couple of times to get around that and go, well, let's ask all your employees to write down on a bit of paper how much they think you make. And then they see that result and they go, give them the numbers. Yeah, so having them more involved in that business. If we want them to be involved and actually able to understand, so I'm not just talking about giving the numbers, I'm talking about we're also going to teach them what they mean and where that sits. So talking about that, creating that ownership mindset, that culture where we get people thinking and acting like business owners. So the first bit is the personnel. We want to have the right personnel for that. So we're trying to create a culture, visibility, accountability, employees aligned with the company's goals and values. Helps identify and develop the right people for the right roles and to eliminate or transform those who are not a good fit. So sometimes we end up in some interesting discussions with employees as part of this process because they might be the ones who don't quite fit. Or they might want to know why they didn't get as much bonus as everyone else this year. Not that they should know that, but they might. Or they didn't get an offering in the employee share plan this year. So we might have some delicate discussions with them, but it gives us that opportunity to have that discussion around their performance and making sure that they understand the company's goals and values and that they fit in with us. Obviously, we're talking about increased retention, satisfaction by creating fun, caring, high performance environment where people are collaborating about helping make the business a better operational unit. So the second part is we want to give them some knowledge. So we want to make sure they know, in particular, we need them to know what drives the success of the business. What are the key elements that drive the success of the business? And then we need them to be able to understand what their role does to contribute to that. Because if we're going to be giving them some sort of profit share or ownership, etc., we want them to know that what I'm doing today is making a contribution to making the business better, more profitable, etc. Okay, so they need to have that knowledge and they need to be able to know how to measure that. So that's where we want to teach them, what do the numbers mean? Yes, we want to give them the numbers. We want to share it with them. We want to explain to them what it means. What sorts of things are we looking at? What are we trying to measure? What gives us, understanding? And we've got debtors. We don't have the cash flow. We can't pay it out. So yes, it's all right to say we're going to do this, but it has a cash flow implication. So having them understand those sorts of things as well. And an important one there is to try and break it down into KPIs. We're talking about also trying to encourage employees to share their ideas around suggestions for improvement, learning from each other, etc. But you don't need to reinvent the wheel. So we were talking earlier about systems and procedures. I often say you don't need to invent a new procedure or a new system or a new process. What you need to do is find the person in your business that does that the best and get everybody to do it the same as them. And now you're operating at the best. So you don't have to invent the greatest system. If you could get everybody up to working to what the best person in your organisation was doing, that would be a pretty significant improvement. The third element is the systems. So we've talked about, okay, we've been through, we worked out with the employees, what are the key things that make our business tick? What makes us profitable? How does our day-to-day job relate to that? So then we start putting systems in place to be able to manage that process, support those business goals and strategies, make sure we've got scoreboards, dashboards, however we want to present it, that we're actually keeping records of things. Again, more talking about leading indicators rather than lagging indicators, so making sure that we can look after things ahead. So they've got a choice of being able to actually undertake that better business performance for us. And then lastly, we talk about our incentives. So we want to try and make sure that the employee incentives, whatever scheme it is, whether it be bonus scheme or whether it be some sort of commission type or income type incentive, or whether it be an ownership plan or something along those lines, that they match that business outcomes, and it means that it motivates the employees to achieve the goals and things that we've set. I've also put there that should be, the incentive should be self-funding. Right, self-funding and understandable. So my example is if we set our budget target and we say whatever's over that, we're going to put a percentage in to that bonus scheme, then it's coming out of that extra profit, if you like. So the more profit we make, the more will go in the bonus scheme for the employees. But the reality is everybody's better off. Okay, so some elements that we usually use, we do an employee survey. So we get the employees, we get their feedback, identify areas for improvement, action items, and then we present those back to the employees. So we're having a good discussion around this last week. So we talked about surveys and how you get surveys for everything nowadays, and people seem to have stopped filling out surveys, largely because we all get too many of them. But the other one is there's no feedback. There's no feedback loop. So some of the studies have shown that if people got some feedback on their survey, they would actually be more inclined to fill it in. So the same with our employees, we want to provide that. So we're going to survey them and ask them for their opinions. Well, then we report back to them on what were the results of that survey. And then they can see the actions we're going to take from there as well. Okay, so from that we can identify these areas for improvements, action items, we give them the results and the financial trends, etc. Depending on what we need from there, we often set up a steering committee. So So they might take those suggested improvements and things like that, try and work out which are the key ones, and then work out how we're going to implement them across the business. So we give them key improvement projects. They monitor those and they implement those across the business. Okay, so then the last bit, as I mentioned, was talking about remuneration incentive schemes and tying that to what we're doing. So let's talk a bit about remuneration schemes. So a few things I want to cover. I suppose we'll talk about salary benchmarking. So making sure we compare our salaries against the rest of the market. So financial planning, do you have benchmarking?
Yeah, Hayes is very good. One source. Hayes is another key one again. Yeah, no, there's another one similar to Hayes.
That again.
Yeah, and
Desmond's still going.
What's going on there? Maybe just froze from it.
Maybe just a moment.
Okay, yes. So for benchmark, making sure that our remuneration packages are competitive in the industry. That's a pretty good starting point in reality. Interesting, I know some surveys that CPA and a couple that were coming through pretty strongly nowadays was more around that flexibility of work, more so than remuneration. And to some extent, we've lost our advantage. I used to think being in the suburbs was good because we could recruit people who lived in the suburbs who didn't want to travel into the city. Nowadays, nobody travels into the city, so everybody works from home or whatever, and there's that flexibility anyway. But I think that's important. We want to benchmark. We want to make sure that our salary packages are commensurate with others and enable us to attract and retain the top talent.
I suppose that benchmarking then also goes to performance as well.
In terms of an incentive as such? Or?
Yeah. Well, if you're talking about like this sort of thing, then you want to make sure that salary is commensurate to the performance as well. That benchmarking across the wider industry.
Yeah. The difficulty with that, of course, is that their resume might look better to another firm than their performance looks to you. The second area we could look at is salary packaging. Does anyone here do salary packaging for employees? Do a little bit. It's not that common nowadays. I've done a fair bit of work in the fringe benefits tax areas. There's not too many advantages. One of the ones at the moment, though, is if you want an electric car, you can salary package that exempt from fringe benefits tax. But there's not too many others. Superannuation is always a good one in terms of salary packaging. So offering that bit of flexibility. Salary packaging is very common for people who work or we all probably know a nurse or somebody like that who salary package gets their mortgage paid and their credit card paid and those sorts of things. When you go out for dinner, they want to collect the receipt because they can get reimbursed for that tax-free and all that sort of stuff. But that's because they come under particular rules and their fringe benefits are exempt. So understanding the different types of salary packaging, super contributions are pretty straightforward. Novated leases can be useful, particularly for cars that are used mainly for private use. And also they can be useful, as I say now, for electric vehicles. Not too many other non-cash benefits. But I think the other area in terms of salary packaging probably comes under it a little bit, as I mentioned before, is that flexibility. So the flexibility of work hours, the flexibility of being able to take extra leave. So I know we've got one employee who takes 6 weeks leave a year sort of thing. So adding that sort of flexibility for people can be part of that packaging. We can have some short-term incentive programs, such as we mentioned those before, bonuses, performance-based rewards. Maybe they motivate employees to achieve immediate goals and objectives. It might be a short-term thing that we're trying to do. If we achieve this, we're all going to have something that I think they're big on those in America. They have their ice cream afternoon or whatever it is when they achieve a certain target or something. So So they might drive productivity, etc., in the short term. But I must admit, I always think at the end of the day, there's a motivation level or a work level that people seem to have intrinsically. And we might be able to do some things that will motivate them in the short term that get them above that. But at the end of the day, they'll return to that same intrinsic level. That's just my experience anyway over the journey. We can talk more about some of the longer term incentives, right? So this is where we're trying to have rewards that are aligned with the long-term company success. So, for example, if we implement a profit sharing program where the employees receive a share of the company's profits as a long-term incentive. And so that would align their interests with the organisation's success and maybe foster a sense of ownership and commitment. So we're not actually giving them ownership, but we're aligning them to that long-term success. Which leads me on to the other potential one, which is employee ownership, which is what we were talking about a little bit earlier. So employee share ownership plans, or ESOPs. So they would be a mechanism that we can allow employees to own the company they work for, with the express intention, obviously, that they'll think and act like business owners.
So do you usually operate with vesting scale on those things, or
What's that? Sorry,
do you usually operate with vesting scale?
yeah. So I'll come to that. Yeah, I'll go through the mechanisms as we get there. All right. So we're talking about employees. If they've got a stake in the company they work for, then either direct share ownership or in a trust that holds shares. There's some different forms of employee share ownership plans. They could be option plans. They could be under an employee ownership trust. And I'll talk about those and talk about the advantages and disadvantages of some of those. So, talking about income versus equity. So we've talked about people getting a share in the profit as we go. But as Nick mentioned before, if we can build up the equity and the value in the business, then that benefits everybody and the employees. If we can get them to understand that value in that equity, then they can also get a share of that if there are owners. So obviously income refers to the money earned by an individual. It's immediate, it's predictable, subject to tax, gives some financial stability, whereas equity represents the ownership interest in an asset or a company, entitling the holder to a share of its assets, profits and voting rights. It's long-term, it offers the potential for capital appreciation, dividends and participation in company growth and success. I understand you all understand that as financial planners. So dropped off an hour, but a few years ago I saw a magnificent graph, great comparison of it went back 10 years earlier. Telstra shares were returning 6% dividend, I think, and the exact same dividend was being paid by Ramsay Healthcare, which was only a 3% return. So lots of people bought Telstra shares to get that 6% dividend. We went forward 10 years and Telstra shares were worth exactly the same and they were still paying the same dividend. Ramsay shares had more than doubled and now their dividend was double what Telstra were paying. So that's the critical difference between thinking of the income is today, immediate, predictable now, versus building up that equity over the long term. What is it? The eighth wonder of the world, compound interest, where that equity is compounding and growing over that longer term. So we want to get employees starting to think about this equity side of that combination. So companies with high degree of employee ownership. So there's been lots of studies on this, both here and overseas. They tend to grow faster, they tend to live longer and they ride out hard times better. They tend to attract better paying customers. They tend to contain better workplace cultures. Workers tend to be better off. Okay, so let's talk about an ESOP, an employee share ownership plan, as a bit of a practical solution. So it helps our culture because people have this sense of ownership amongst the employees. It helps with our engagement. So employees who are owners, they're more likely to feel engaged and invested in the company. Can help us with productivity. So studies show employee-owned companies often have higher productivity. So especially if we've mapped our performance back and people know what the KPIs are and what they need to do to actually improve the business. And so therefore that increased productivity, improved performance, they actually know what they are doing and how that contributes to that. We can use them for succession and exit plan. So that can be a good strategy for actually owners to be able to exit out of the business by passing on some of those shares to the employees. And it also means that you might be able to extract some cash before retirement. So if you're selling off part of the shares or some of those shares to an employee share ownership plan. Just one of the studies talking about performance increases ranging from 7 to 23%. So when we get that employee share ownership plan right. The psychology of ownership. So ownership is a bit of a motivator for employees. I actually own some shares in the company. So that obviously has psychological benefits. So we're focused a little bit on the financial benefits, but also there is that psychological benefit that people actually feel better because they are part owners in the company. So obviously it can be a bit of a motivator. So it is that ownership bit, the sense of ownership. We have a better connection and commitment. And it instills more of a sense of responsibility and accountability. So that psychology of being an owner. I mean, we often talk about if only my employees would adopt the same attitude as we did as our owners. So that's what we're trying to get to. I think there's some other elements to it. If we talk about autonomy, autonomy is an interesting word. We often talk about that. The flexible workplace is one that allows us to actually provide employees with a lot more autonomy about how and when they want to work, but also they have a bit more control over their lives if they're also part owners in the business. And if the business grows and develops, they're going to benefit in that as well. Obviously, that more belonging, we're all sharing, we're all owning together. Some pride, accomplishment, a source of stability, security, all those psychological factors. So there's a lot of them in addition to the money ones that we've been talking about. Now, let's talk about some different options as far as employee share ownership plans go. So there are a few different types of employee ownership plans. There are startup plans. There are also performance rights plans. There are tax deferred plans. There's a peak performance trust. So I'll talk about some of these and things that as we go through with them. So if I talk about startup plans for a moment. Sorry, these are a particular beast. They are very tax advantageous. They've been mainly designed to encourage employee ownership in new startup ventures, largely in the IT sort of space. Interesting, they call them startups, but the reality is they can be up to 10 years old, and as long as they have a turnover of less than 50 million. So we can have some fairly significant businesses in the startup plans. They can't be listed on the stock exchange. The company must be an Australian resident taxpayer. So for employees here, they have to have less than 10%. Each employee has to have less than 10% of the total shares. They need to be employed by the company. They've got to have less. When they get given the shares or get provided with the shares, they can only be given up to a 15% discount. They've got to hold them for more than 3 years, and 75% of employees with more than 3 years service have to be offered those shares. So there's just some of the rules around the startup plan. Because it's quite a tax advantageous type plan, it's no upfront tax when the employees get the shares, there's no tax when they vest, and there's no tax when they exercise any options or anything like that for the employees as well. So it can be quite a really good tax effective one. We don't have too many startup plans because of the restrictions around on the other side. But good tax options, and we have a number of we have a few, but not a lot. The other one that sometimes we use is a performance rights plan. So here we talk about the employees, they have the right to acquire or be gifted shares upon achievement of certain performance criteria. So a lot of the larger listed companies have this incorporated into their employee share plans. So they go to one of the key managers, you've got the right to acquire 100 shares at today's share price in 2 years' time if you've met certain KPIs, etc. So they're like a bit of an options type plan, performance rights. And so then the employee can actually buy them at that price in the future. So they'll often be measured. You'll have some indicators around what are those key performance criteria. They could be on profitability or maybe turnover, growth, return. So it depends on the level of the manager in the business and what sorts of things they control and what their KPIs are. I'll talk briefly about deferred tax plans. So employee share plans in Australia, we can use deferred tax plans. Some of you may have come across these with your clients who are in deferred tax plans. So, for example, under the current rules, deferred tax automatically applies to an interest if there is a real risk of forfeiture or the scheme's salary sacrifice arrangement. Let's talk about this risk of forfeiture. So if I get given employee shares by my employer, but if I leave and I don't get all the shares, then they're at risk of forfeiture. So I don't have to pay tax on those shares at that point. So what happens is the tax is deferred until until there's no risk of forfeiture or 15 years at the maximum. So in terms of maybe if there's no risk of forfeiture, so for example, if I continue on and I'm after 10 years, whatever happens, I will get the shares, then they're no longer at risk of forfeiture, then I would have a taxing point. Or if I, for example, I leave the company and I take the shares with me, then obviously there's no longer at risk of forfeiture. Or up to 15 years. So there's a tax advantage there. We can give employees shares, we can either gift them or give them a discount. That is taxable, but it's not taxable today. It's deferred until some point in the future, usually when they get some benefit from those shares. So either when they exercise their right and there's no risk of forfeiture, in other words, there's no genuine restrictions anymore on the disposal of the scheme. So again, that often applies when we talk about larger public companies and they have their schemes in place. They get to a point where the employee can now sell their shares on the stock exchange, so that there's no restriction on them anymore, then they would pay tax at that point. If we're talking about smaller businesses, there may well still be some restrictions under that scheme for where they can dispose of the shares because we don't want them selling them to anybody. So we'll have restrictions on that. So usually when we put a plan in place, the time when they'll be taxable is after 15 years. Okay, so then I want to talk about the peak performance trust. So in most cases, this is certainly my preferred model. Succession Plus is most common model in terms of how we would implement an employee share ownership plan. And it's got a number of advantages over some of the others. So let's talk about this. So a peak performance trust, or a PPT as we call it. So it's an employer-created employee share ownership trust. The company can make contributions on behalf of the employees into that trust. If we're talking about this as a performance bonus type scheme, then what we have is the company would commit to making an amount of money in there on a regular basis, assuming we meet the targets. And as profits increase, so do the contributions. So we set our target, I said before, maybe we set a target of being 80% of what our budgeted profit is, and we say anything over that, we're going to put 20% in. So we exceed our target figure, we take that 20%, we put it into the employee share ownership trust. Okay. So there's some benefits, there's quite a few benefits, if you like, in terms of using this type of structure. So first, any of the others, we obviously the employees now have shares, or we structured so they've now got shares in the company. So their future's aligned with the company's to some extent. Their financial goals are the same. To some extent, it's that sort of golden handcuff, and I'll show you how we do that in a moment. So just to give you some diagrams to maybe understand how this structure works. So we've got Mr. and Mrs. Smith over here who own the company. They set up the Peak Performance Trust. So we've got a trustee over here, or a trust that holds shares on behalf of the employees. Okay, so the only thing that Peak Performance Trust is allowed to do is buy shares in the company. So Mr. and Mrs. Smith, for example, are sitting here. The company, Smith Engineering, makes some profit, meets that profit target, puts the money into the Peak Performance Trust. Okay, the Peak Performance Trust then buys shares in the company with that money and holds those shares on behalf of the employees. All right, so a couple of things here worth talking about, brings a few things together we've spoken about today. So one is we talk about the profit share and setting that target, making sure we've got the right benchmark. It relates to our KPIs. People can see how their performance will impact on that profit. And that's what goes into the Peak Performance Trust. And it will use that to buy shares in the company.
Is that a disposal then, as the shares are acquired by the trust, is that a disposal for the owners?
So it could be either. I'll come to that in a sec. No, that's fine. That's fine. Good question. So then the trust will issue units to the key employees, and effectively 1 unit for 1 share. All right. So the units they hold in that trust will be representative of the shares that they effectively own in the company. All right. The second element of our performance type bonus type scheme is that we determine which employees are going to get how much of that money in there.
So that overcomes the problem of the earlier model where you had to offer it to 75% of the employees, some of whom may not be the.
So we have
you may not wish to extend an invitation to some of those employees if you've got to capture a minimum of 75%.
Okay, so if we want the deferred rules, so this is a deferred tax model. So I mentioned deferred tax at the moment. This meets the requirements for that. There are some rules around having to offer to 75%.
Yeah.
However, it doesn't mean we have to give them all. How can I describe it? It's not give them the opportunity, but it is invite only.
Okay.
But we set a criteria that they might meet the criteria, but we don't invite them because they haven't met the performance targets and things like that. Okay. So this is where we would determine how much we're going to give them based on. I would normally do it. I think the most effective way that I would normally do it is a formula that's based on salary, either salary or level of management in the business, because generally we want higher managers to get more of a share than lower. Not necessarily, not always the case, right? But we might do that. If we don't do it by management level, salary is a bit of a measure of contribution to the business, I suppose. And then the second element is their performance. So usually the score that we would have on their annual performance review, for example.
Sorry, Steve, can I ask another question?
Yeah.
Is the only way that money can enter the trust by way of the business contributing, and the personnel put money in there to acquire shares as well?
Yeah, they can do that. So I'll go through those in a minute.
Sorry.
No, that's all right. That's fine. That's fine. Ask away. You need to know the answers. That's all right. So we've now allocated to our key employees. A couple of other things about the structure here, right? So if the company puts the money into here, it's tax deductible to the company. Right? So that profit share that we put in there is tax deductible. It then buys equity. So the question was, does it have to buy it off Mr. and Mrs. Smith? No, it doesn't have to. So 2 ways that the company can acquire equity. It can either buy it off Mr. and Mrs. Smith, which will give them some money in their pocket that they've got before retirement, effectively, or we can issue new shares, which means the money goes back into the company. Mr. and Mrs. Smith's ownership will now be diluted, right? But in actual fact, the value of their shareholding will stay the same as what it would have been anyway. And I often talk about this. Some people don't like to give away too many of the shares, etc. Don't like to be diluted. You're better to own 95% of something this big than 100% of something this big.
And does it matter how Mr. and Mrs. Smith are holding those shares, for example, personally or via an entity?
So it doesn't matter to the trust. It might matter to Mr. and Mrs. Smith in terms of their own tax issues, etc. Yep. Yeah. That actually gets around. I think you mentioned before about if they gift shares, we can have some capital gains issues there. So we're not actually gifting shares; we're buying them off them at market value.
Understand.
Okay. The other thing that I really like about the structure, this is some of the best things, is that we use this trust, and we have a corporate trustee. So the corporate trustee, the directors of that corporate trustee, we make sure that it is Mr. and Mrs. Smith, for example. So Mr. and Mrs. Smith are the directors of Smith Engineering. They're also the directors of the corporate trustee. Now, they're bound by the rules in this trust, right? But when you think about it, the shareholder is the trust. Shareholders get a vote in what happens in the company. That vote's controlled by Mr. and Mrs. Smith. So
Sorry.
that's all right.
Thanks.
Yeah.
If you've done a good job, we'll give you some shares on it.
Oh, you want to over that side, Paula, sorry.
No, no.
It's
This is
the
fine
third
here.
get from you.
Thank you.
No worries. Anything else?
Bruce, the red one.
Oh, that was you, Matt, that was supposed to be your contribution. Thank you so much.
No worries. Yeah. Yeah, just send it down.
If you can mark
Yeah,
it
I
on
would-
the order, I'll take that off.
Yeah.
Just the latter.
Thank you.
So sorry, just revisiting. So Mr. and Mrs. Smith control those shares. Control the vote because they are the trustees of that trust. So different to where we might give employees direct shares in the company. Once they've got 5 shares in the company or 5% of the shares in the company, they've got rights under ASIC as a minority shareholder. And so we can avoid that a little bit by having this trust in place. Mr. and Mrs. Smith still hold that control, if you like. The other thing that happens is that the trust is not listed on ASIC. There's no company register. So our employees can't go on to ASIC and do a company search and find out who owns all the shares. So yes, they might own different amounts in this trust. They won't know who owns which amounts unless they tell each other. Whereas if they've got shares in the company, anybody can go and look up on ASIC and do a company search and find out that Joe's got 5%, he's got 7%, but wonder why that's the case. So that's how we separate that by using that trust. The other thing that happens is because we have a trust deed here, we can write in a whole heap of rules in there that don't come under the Corporations Act. So if we have a company, we're limited in what sorts of things we can write into the company constitution, but with a trust deed, there's more rules and things we can put in place there. So that's why that structure, some of the reasons why I think that structure works pretty well. So just a quick example, if we, let's say we set our profit benchmark to be 800,000 net operating profit after tax, and we said that whatever we make over and above that benchmark, we're going to put 20% in as a contribution. So let's say we made a profit of 1.2 million. So we're 400,000 above the benchmark, we're going to contribute 80,000. All right, the 80,000 goes in, that's going to be a tax deductible contribution into that employee share plan.
Steve, are those values of the contribution predetermined at the start, or is that like a foundation manual review as a percentage?
Yes, so we can do it on an annual review. Yeah. So normally what I would write in is that we're going to set our benchmark each year, and we might do an estimate of it at, say, July.
Sorry.
No, that's right. So we might say we'll do an estimate of what this is in July, but we'll confirm what it's going to be by October when we've done the last year's accounts. We've got our budget for the next year. Now we're going to set our benchmark. But we do it each year, subject to annual review.
But then that, like 80,000 represents 10% of the benchmark. Is that,
you can make whatever rules you like.
And that's reviewed every year, or can you just say it's 10% moving forward? But it's a lot.
No, you can change it each year. Yeah. Okay. So this is just an example. So we're going to put our 80,000 in here.
Sorry to interrupt, but I think I'm just thinking, like, if let's say it's 800 and the business decides, no, we're going to reinvest the whole lot this year, as opposed to putting it in trust, or we're going to put it on. We just want to have a place to really be able to move that dollar value around a bit. So you could still achieve that. So we draw a check from the company to the trust for the 80,000. We use the 80,000 to buy shares on behalf of the employees. If we issue new shares, that 80,000 will go back into the company.
So we've reinvested into the company anyway. Just a couple of days where it's not. Comes out and goes back in again. So that's what happens. The 80,000 goes in here. We use that to buy shares on behalf of the employees. Okay, and we allocate these by invite according to their performance, etc. So now they own, for example, 1.5% of the shares in the company. The employees do. That means they'll receive dividends. So if we pay a dividend, then the share of the dividend will go to the trust. The trust will pay the dividend out to the unit holders by way of that distribution.
If you're getting people to sort of like this, go into this, or if they wanted to contribute anyway, is there a certain understanding as to like how much of the profits are you going to pay as dividend on a year-on-year basis? Like, you know, you've got some shares.
Yeah.
Get any income, or what's the?
Yeah. Okay, so it's worth a discussion around a whole heap of things within your business that you want to contemplate here, right? So if we're talking about setting a criteria for who's going to get these, and we want to set our KPIs, etc., I would structure that back to what goes into everybody's job description, KPIs, etc., so it all flows through. Sorry, your question was about how
to determine like obviously with the dividends.
Sorry.
Mr. Smith gets to decide how much.
Yep.
Because they're the owners and the directors of the trust and the company, so they're deciding how much of a dividend that they pay anyway. So even though you've got equity over here, it might be growing a little bit, but do they, like, I guess that, just having a clear understanding for the employees.
So your point's really good. So yes, Mr. Smith get to decide that because they are the directors, they get the vote, they decide. So that's what I was talking about coming in. Lots of the other documentation you might put together around that, I would encourage you to have a dividend policy, which could be as simple as we aim to pay out 50% of our profits in dividends each year. But that doesn't mean they have to each year, but it gives a bit of a guide, and probably if they're not going to do that, they want to provide a different, maybe some reasoning why they don't want to do that, and explain to everybody, well, we're investing in some growth, therefore we want to keep it in, or so some other logic there. But technically, yes, they have say in that.
Hypothetically, shareholders are disadvantaged if the dividend's not paid out because the money stays in the company.
Yeah, correct.
The company's higher, therefore the value of their shares is higher.
Yeah, correct. That's right. The other things around then, I can't remember what's on these slides.
Because I guess
I want to go back.
Some people might have costs that are stripped out if you are the owners or directors and things like that.
Yeah. Well, that's so we always use
this conference.
So we always use the normalised profit. But you're right. I've had that discussion. And one fellow, he actually didn't have an employee share plan, but he'd given some employee shares, and we were talking about his profit. He said, it's higher than that. There's about 170,000 of my private travel goes through there each year. And I said, well, I'm assuming that won't go through there now that you've got other people who own shares in the company. Oh, no, they'll understand. And I go, I bet they won't. It's their money. So that's where we would use it. We would try and use it normalised profit.
Best class all the way.
Some other things just generally around it, right? Not really on the slide, but just to talk around it a little bit. So I've talked about using this as a performance type arrangement, right? So where we're going to put the money in out of profits, not costing the employees anything. So what happens to the tax on that? As I mentioned before, they've got these shares for nothing. We have to do a valuation each year of the company so we know what the value it is. They get them at whatever the last valuation was. So we know what value they've received. That's taxable. However, they don't pay tax on it now. They pay tax on it either when they leave and get their money or 15 years' time, for example. And at that time, they pay tax on the value of the shares at that time. And then beyond that, any capital gains, that will be their cost base. So they will pay tax. but it'll be when they actually, usually in most cases, it's when they sell the shares, for example. So they've got the cash, they pay somebody in tax, hasn't cost them anything. The other thing,
Assuming it's a growing business, wouldn't you rather pay the income tax
and Pete,
and then the CGT on the?
yeah, so you can make that choice at different times where you can pay the tax at the start. On the cash flow, it's advantage people who haven't got the money to be able to do that, you know.
So could it be up to the employee to decide, or is that
It's probably more how we structure
how
it.
you structure it?
Yeah. I also, the other thing that is relevant there is that what we try and do is structure it so that we have a table that lists what shares or what they'll get paid out if they leave, and we put some restrictions on that. So day one, they get 100%. They have 100% of their units in that trust, right? And so then we provide what we call a forfeiture type discount. So you can structure it how you like, but we usually use something maybe over 10 years. So if they leave within the first 12 months of getting those units, they'll only get 10% of it. They leave in before 2 years, they'll get 20%, 3 years, 30%, etc. So they get some units for nothing today, but if they decide to leave, then they'll only get a percentage of those until they've been there more than that 10-year time, and then they'll actually get them all.
Can you structure a buyback? I mean, you may not want, if they're not there, and they're not contributing to that growth and outcomes and things like that. Yeah.
Well, if they're still there, if they're still employed, they would keep their shares.
Of course, but specifically about people who decide to leave.
Oh, yeah, so it's automatic. Their shares will come back.
That's part of the structure.
Yeah, that's how we would. That's how we would structure it. We always structure it as well so that they don't get paid for usually 12 months, maybe 18 months after they leave, and that's for two reasons. One, we need the cash to be able to do it, but the other one is that we then look at whether somebody is a good leaver or a bad leaver. So a bad leaver might be somebody who goes and works for the opposition or goes and starts up their own firm, takes clients with them, etc. So that's why we want the 12 months, because they might be a good leaver the day they go, and 2 months later they become a bad leaver. So bad leavers, we usually structure, they don't get anything. So a good leaver is all the others that are just subject to that discount. So we're encouraging them to stay, right? And each time we issue them with new units, that the clock on those units starts. So it means that at any time if they're going to leave, they'll be leaving some value on the table. So that's the encouragement for them to stay in. So they own all the units from the start, so they get the full dividends and so on.
So the trust issues new units year on year or based on that. So then it's easy for a new person to enter the scheme, because if they enter that scheme, then they may get an entitlement of the new personal employed.
Correct, yep. And so
you're not selling.
No, that's right. But we usually set some criteria as to who can go in it. So it might be they have to have worked here for 2 years, or be a certain level within the business and that sort of thing. Set those criteria. Some other things that are relevant. So I've talked about using this as this scheme to actually encourage employees, etc. Performance bonus. Our trust will also allow people to buy shares, or buy units, I should say, which can then buy shares. It will allow them to salary sacrifice. It will allow them to borrow money to buy some. It will allow the trust to borrow money to buy some. So we don't have to offer those, but I must admit I always include those in the deed to make sure that they've got those options. So we start off doing it as a performance thing, but in 2 or 3 years' time, we might decide, oh well, we're going to offer some shares. If people want to buy some, they can buy them. Put their own money and buy them in here. Obviously, if they've used their money or they've salary sacrificed to buy them, then they're not subject, obviously, to the good leaver, bad leaver, and they're not subject to the discount. So when they leave, they'll get the full entitlement because they pay for it.
You have different class of shares.
No, they'll still be the same class of units, they're just not subject to that discount.
Can the units convert in the future to the equity, to the?
Well, you could do, or we could actually sell those across and actually issue new shares in exchange for it. So you can do that, yeah.
They are the shares of the company, aren't they?
No, you've got no voting rights, right?
Units reflect.
But you've got no voting rights.
Yeah, they do, but they're not direct. So we might get to a point.
You're just a unit holder, so you're not actually getting any voting rights. So if you actually want to have a significant holding in the same company does, unless there's a management transition that was part of the earlier discussion,
You might get
don't
to a
actually
point
have any say.
where you want to sell your business to one of the employees, and there's 20% shares units in here, and they own some of those. They're happy to buy the rest, so they're going to buy all these shares over here. So it would make sense for their shares in here to actually come over here as well. So they become Mr. and Mrs. Smith.
Those, let's say they got 7% of that pool. So their 7% will come out.
Yeah.
15 will
Yeah, leave the other employees in there, for example.
But by the sound of it, I mean, like, if you're just putting depending on what the value of the business is, but you're putting a small portion of the profits into that area, and then you've got a smaller share of that, of the overall business, like, it's not like you convert it, like, you might have 25% of the trust, but that might only equal 1% of the overall business.
So the reality is, it starts little.
Yeah.
Right, but if you're doing this each year and it's making profits each year and getting bigger each year, then obviously that compounding growth is significant.
So, Steve, what if you start the program, you have a 2-year hurdle, people have been there 2 years, issue the shares.
Yeah.
And then they quit 1 year later.
So if you give them the units, 1 year later, they'd probably only get 10% of their entitlement. So you set those rules.
No, it's been.
Yes, yeah. Sorry, go on.
Oh, are you saying that they'd only get 10% because they're
Because they've left within 12 months.
within a certain time period?
Oh.
In the like the rules of the
Pocket trust.
Yeah.
Yeah. You set that time for 10 years.
Yeah. Yeah.
Golden hand.
And people do it differently. Some say you only get 10% up to the first 3 or 4 years, and then after that you get 50%, and after that you get 100% sort of thing. So you can structure it how you like. The easiest table we always use is just the 10-year table. It goes 10, 20, 30 down to 100%. So
Employees contribute to their own money.
that was a bit.
yeah, so they yeah, that's right. They would get all
They
that.
got full
Got all that.
Do you see much, like on the distributions that come out of the trust, like rules around reinvesting those?
So
Like
you can allow those, whether you want to or not's another thing. It depends whether you want the employees to get out of some advantage, some disadvantage, whether they want the money or not. So in reality, it's just the same as them using their money to buy shares in it.
You wouldn't say like, yeah,
But you could have
30% of
dividend reinvestment plan that's
Yeah,
cheaper than it's,
Yeah, you could.
But you'd have to give them a choice.
yeah.
You could. And you don't have to allow those things. So.
The employee might be able to get 5% discount if they reinvest a dividend into the.
So the other thing that happens is this trust here, if you wanted to, the trust could actually borrow money to buy more units. So the individual unit holders could borrow money themselves to buy more units, or maybe to keep it even for everyone. The trust itself could go and borrow. Depends on the security and so on that's offered there. We've seen Macquarie Bank have been okay to lend to the Peak Performance Trust on some different occasions, depending on the industry and so on. To buy
Have you
shares.
established any relationships with any specific banks that understand your structure and indeed?
Well, certainly, as I say, Macquarie do, but most of them it doesn't matter. Trying to think, were there other things I wanted to mention?
the midterm administrators still have to provide the guarantee for like.
Yeah, depends, but probably, yeah.
Steve, at some stage, I mean, you mentioned the 5%. It's going to climb beyond 5%. It just keeps going.
Okay. So yes, so in your deed you can write maximum. So you might write that the maximum that the trust can own is 20%, for example.
Yeah.
So when it gets to 20%, it's not gonna buy any more unless somebody leaves and you put some more in, etc.
That's the trigger of course.
Depends what you want to do. There's a couple of these that we've seen that their aim is for the employees to own 100% at some point in the future. And so they're up to around about 48 or something like that.
So if the employees own 100%,
Yeah.
but they've got no vote.
Okay, so So we can change this at any time.
Yeah.
So what generally
Day one
happens?
comes as
So
direct.
day one, we have Mr. and Mrs. Smith. That's fine. And that's how we want to keep it. But we have some significant shareholders. They're looking like they're going to take some management control, those sorts of things. We can appoint them here.
Yeah, it's direct.
Yes. As directors. Yeah. I'm doing one at the moment where the owner is going to be the director, but also 2 of the employees and the external accountant. So they're going to have 4 directors. Okay. And in reality, what we're trying to do is have the values align with the business owners, have the employees thinking like owners. Now, we often talk about having shares, having employees with different shares and different classes of shares and different things like that. Depending on how we're going to do that, if people are going to buy shares, then we might give them the same class of shares, etc. There's lots of issues with people when we actually sell shares direct, unless it's part of a longer term plan, actually, succession plan. And I know I've got one of them. They have got B class shares that one of the directors decided to give an employee some B class shares and he didn't know what they were.
Different voting rights?
And, well, it wasn't defined. So, in fact, he's got voting rights and everything else. And, of course, what happens is that whenever new shares are issued, the Constitution said they had to be offered to all shareholders. So this guy had to be offered shares when they were selling to somebody else and he bought some of them. So now he's got A-class shares as well. He didn't pay for his B-class shares. He gets as big a dividend as everyone else. And the guys who formed, the other partners in the business are going, we wish we had B-class shares. We pay all this money for our shares. He's getting the same benefits as us. So just being careful around how all those things work. They can be difficult structurally. This keeps it a bit separate, if that makes sense. It still gives you that sort of control. So, any reasons why you wouldn't consider an employee share ownership plan? There's one potential reason why you wouldn't, because I'll tell you the cost. So when we set up an employee share plan, the normal cost is about 25 grand to set one up. And then you need ongoing assistance because you've got to have a valuation done each year and maintain the records for the employees, etc. So you end up paying about 7 to 8 grand a year to maintain the valuation that up to. So it's not for the tiny businesses, but it's only the medium-sized ones. It's become very popular. All right, let's have a look at a couple of case studies. So, a professional services firm in New South Wales started their ESOP in 2018. They had 33 members who owned 14%. Now they've got 120 members who own 45% of the company. Just as an aside, there are different things you can do. We have owners who put money in, who gift, want to give an initial gift. So we have issues with gifting the shares, but we could actually gift some money in as an initial bonus, not tied to performance. Maybe just to get it started, we put some money in, buy some shares on behalf of the employees to get it started so they've actually got something in there. We laugh. I had one, he had his 6 managers and he gave them $40,000 worth of shares each. And one of them wasn't happy because he thought he contributed a lot more to the business than the other managers. And the guy who gave the gift of shares said, I've never heard of anybody complaining about getting 40,000 for nothing before, but anyway. And in actual fact, that business is just on a huge growth curve. Those 40,000 will be worth 100 in no time. Anyway, so their valuation growth has been significant. I'll actually show you that at the moment. I think it's on the next slide. A much more people-focused, team dedicated. It's a unique structure. Their aim is for that 100% goal at the end to be 100% employee owned. They have the ownership mindset process. They do a lot of that. Learning, adapting, team morale, sustainability, acquisition, financial benefits. This is what's happened to their valuation in that time. So I showed before the report where we have the current valuation and the potential valuation. So back in 2018, 2019, their valuation was about 7 million. Their potential valuation was about getting close to 10. So here they are, they're now with 13 million, potential 20. So the employees are working to try and get up to that 20, of course. But so good increase in that period of time. So those employees, how many was there? 14%, 33 members who owned 14% at the start have had a bit of growth over that period of time. Sorry, it's worth 20 million now, and the valuation increase has been 13 million. So we've gone from 7 to 20. So again, that longer term growth for the employees. Queensland Equipment Rental Company. So in 2019, they had an employee share plan. They had 7 employees. They gave 6,637 units at $33 each. Now they've got 30 employee owners with nearly 40,000 units, 8 allocations completed. The units are valued at $90 each, gone up from the 33. So obviously big growth, etc. And the same, their valuation has gone from just over 70 million to 132 million, so a $60 million increase between 2020 and 2024.
And so just to go back a few steps, then the issuing of the units doesn't need to be fair, does it? It can be based on the performance.
It's based on invitation.
Yeah.
And you can structure the criteria however you like. I always say, let's try and make sure that everything matches. Let's have a really good performance review where we're measuring where they're going against the KPIs and give them a score. Make it a score out of 100 so you can delineate between people. I try and do it with 5 areas, pick 5 areas and a score out of 20 on each of those.
Mm-hmm.
You know, so you've got a reasonable mark. We multiply that by the salary to form a number, and that's how we calculate the proportion that they get.
Because you might have like an administrative staff member that's been around for 10 years, very important to the business, but perhaps not as important as someone that produces the revenue.
Yeah.
So they might get a smaller amount of units.
Yeah, that's right. Yep. Mm-hmm. Questions? Just a couple of other things I will mention. So Carolyn sent around an email, I think, that had a link into a value gap assessment. Some of you have done it. So what'll happen is when you fill it in, it'll come back to me and I can have a quick look at it and I'll email it to you. It does a bit of an analysis, a little bit like this. It goes, well, what is the value of your business? I'll preface that by saying it's a very rough valuation because it asks you for some information. It depends on what information you put in. It's fairly limited, but it gives you a bit of an idea. And then it actually, more importantly for you, it tries to identify if some of those non-financial things were fixed, what would be that impact on your valuation. So that's where we're trying to identify the valuation gap. So if you haven't done those, if you fill them out, if you want to at any time, and they'll come through to me and I'll just send them through to you so you can have a look at those questions, I suppose. We've covered an awful lot.
Steve, I assume the cost that you mentioned before, 25, was 7 or 8 million dollars.
Yeah.
The 25 would include the design or draft of the rules. So
yeah, so that is the design of it, set up of the documents.
Yeah.
I should add those disbursements on top of that, about 4 or 5, which is setting up corporate trustees, those sorts of things as well. So, but the 25 is the whole design of this. It just gives you an idea of where the cost is.
The valuation on the option part, like, is that having an accountant do it a year on year, or are you seeking a specific professional to? So
I showed you some snippets from our Business Insights report at the start. So we update the Business Insights report each year. So that does the valuation based on, say, about 120 non-financial factors that determine the risk. It also takes into account the risk in the economy, the risk in the industry, and the risk in your business to come up with the multiple, what your profit is, averaged over a period of time, etc. So that all gets updated each year, which means if you're improving those factors, then it'll be improving the multiple, et cetera, as well as it goes. We actually don't do it on a multiple, we do it on a weighted average cost of capital calculation, but everybody likes that converted back to a multiple.
Yeah.
So,
If people say they've got too many questions, they'll make contact with you directly.
yeah, sure, yes. And look, the other thing, you're all financial planners, you've probably got business clients. If you wanted to, I'm happy to come and talk to any of your clients, or if you wanted to put on a session like this for your business clients, we can do that as well, because it could be something that you might be able to offer them as well. Because I think it ties in. I mean, as I said, whilst I'm an accountant and financial planner, I work a lot with lots of different accountants and financial planners helping their clients through this sort of process. And you can be very much a part of it. As you saw at different stages there, we need to involve the financial planners, and probably more than you think in terms of the process, because what we're trying to get to for most people is a point where they've got enough money to retire on.
Do many of your clients bring up the succession planning and what they're doing with their businesses? Yeah. Yep, started. Really? Yeah.
Stephen, do you do speech pathology businesses? That's a no, that's a hard no.
So generally, it
It's
depends.
very consulting, heavy based, so.
Yeah. So generally, we'd work with businesses that turn over between, say, 5 and 50.
Okay, yeah.
So smaller businesses, the same principles apply, but they don't get the same sort of benefit out of
Yeah.
our work as such.
Yeah, I mean, they might be up to 5, but yeah, it's going to be lower.
Yeah. The other thing is because depending also on the various professions, so doctors can be difficult, speech pathologists probably because their registration is personal, can't be transferred to somebody else like a business can, for example. Their relationship with their clients is personal. So there are some models. Obviously, we've seen models of the larger clinics where they're trying to make it more of a clinic than the individual doctors, but the individual doctors' practices are hard to deal with in terms of succession. Yeah.
I don't have any other questions or any questions online.
We're about the right time, Karen.
We are about the right time. Well done, Steve. So thank you to everybody, and thank you, Stephen. And that was really, really valuable. I know that it's quite heavy, and 3 hours is a lot. So, but thank you for taking the time to come and present to us today. I do have your evaluation forms. Give me 2 seconds. And I will share these with Steve. So just on the right-hand side there, if you want to scan that one for your evaluation form for Steve's session. So that's a combination of session before lunch and this one that we've just had. And I'll circulate that to you, Steve.
Okay.
So you know.
That's that feedback loop on the server.
There you go. Feedback on the server. Lovely. Well, thank you. We're going to have our afternoon break now. So we'll be back at 3. Thanks all. I'll leave that up for just a few more minutes.